Farmers are already making decisions that could tighten supply later this year. And at the exact same time, the system behind them is getting more expensive, more leveraged, and more unstable. That combination doesn't usually end clean, because right now you've got fewer corn acres being planted, fertilizer still acting like a risk, not a cost, and farm debt climbing to record levels while exports are slipping. That's not one problem, that's pressure building across the entire system at once. This is Boots and Bushels, your daily look at the markets that feed America. Let's start with the one that should get your attention immediately. Farmers are cutting corn acres. A new survey of 4,000 producers shows 20% are reducing corn and shifting to other crops to manage fertilizer costs. That's not a minor adjustment, that's a signal. Because when growers start backing away from corn, it tells you input pressure hasn't been solved. It's being avoided. And here's the risk. If enough acres move away from corn, you're not just managing cost, you're setting up a tighter supply situation later on. So while the market might look calm right now, the decisions being made this spring could show up as volatility later. And that ties directly into the next piece of this story. The government is now preparing to step in using billions in tariff funds to stabilize fertilizer supply. That's not normal behavior. You don't start talking about using that kind of money unless there's concern the system could break or tighten further. So this isn't just fertilizer is expensive. This is fertilizer becoming a national risk point, which means even if the prices back off short term, the underlying issue is still there. And for producers, that keeps one big question on the table. What happens if fertilizer spikes again mid season? Now layer in what the market is already doing. Corn and soybeans are starting to push higher on weather concerns and export activity, while wheat is slipping. That split matters because it tells you the grain complex isn't moving together, it's reacting to different pressure points. Corn and beans are trading risk. Wheat is trading lack of support. When markets stop moving together, that's usually when opportunity shows up, but so does volatility. Now, here's the part most people overlook. The USDA is sending out $2.5 million in disaster assistance for stored grain losses from the last couple of years. That doesn't fix the problem. It proves the damage is still there. Because while everyone's focused on this year's crop, there are still operations trying to recover from the last one. And that recovery pressure doesn't go away, it carries forward into decisions being made right now. Let me give you the bigger picture before we go further. You got producers cutting acres, input risk still elevated, and operations still recovering losses. And we haven't even gotten to the balance sheet yet. Because this is where the pressure really starts stacking. Ag exports are projected to fall from 196 billion down to 170 billion. At the same time, farm debt is expected to hit a record 560 billion dollars. That's a dangerous combination. Less money coming in, more money owed. That's where margin pressure turns into real financial pressure. And when that happens, producers don't just make different marketing decisions, they make defensive decisions. It can mean fewer inputs, fewer acres, or less risk taking across the board. Now let's bring cattle into this, because this is where it gets interesting. Herd expansion is still low, and the reason is simple. There's not enough heifer retention. So even with strong cattle prices, producers are not aggressively rebuilding. That keeps supply tight, which supports prices. But here's the tension. You got strong cattle prices sitting on top of a system where feed costs are still elevated and financial pressures building. So the question is not whether cattle are strong. The question is what breaks first. Do feed costs ease? Do margins tighten? Or does expansion stay low longer than expected? Now add in what's happening globally. Canada is coming off one of its driest years in decades. That doesn't just reset overnight. That affects how aggressive producers are going into this season. And if production stays under pressure there, that matters for broader supply expectations. And then you've got South Korea importing eggs from Thailand to control rising prices. That's not just a food story, that's a signal. It tells you protein markets are still tight enough globally that countries are adjusting supply chains to manage price spikes. That's how sensitive the system still is. And here at home, Purdue is shutting down a Tennessee plant, over 400 jobs affected. That's another piece of the puzzle, because when processing capacity changes, it impacts producers, logistics, and local markets. These are the kind of shifts that don't show up in futures right away, but they matter over time. So when you put all of this together, here's the real takeaway. This is not a calm market. It's a market where pressure is building in multiple places at once. Acres are shifting, inputs are unstable, Debt is rising, exports are weakening, and livestock supply is still tight. That's not one story, that's a setup, and the risk right now is simple. The market hasn't fully priced in how all of these pressures could collide later this year, because this is the kind of setup that doesn't stay quiet forever. Now, this week's weather pattern is being defined by active storm tracks setting up across the central United States, bringing multiple rounds of severe weather along with ongoing moisture concerns in already saturated areas. The biggest focus is a renewed threat of severe storms developing later this week, beginning across the plains and expanding into the Midwest and eventually the Ohio Valley. Areas like Oklahoma and Kansas through Missouri, Iowa, Illinois, and into Wisconsin are in line for strong thunderstorm activity. The primary risks include large hail, damaging straight line winds, and the potential for tornado development. This system is expected to move east as we head into the weekend, spreading those same threats into the eastern Corn Belt and Great Lakes region. This comes on top of ground conditions that are already under pressure. Many areas across the Midwest have seen multiple rounds of rain recently, leaving soil saturated and increasing the risk of localized flooding. With additional precipitation expected this week, the concern shifts from just rainfall totals to timing and accumulation. Fieldwork delays are becoming more widespread, and there's growing risk of nitrogen loss in areas that remain waterlogged. In some cases, attempting to work fields under these conditions could lead to long term soil structure issues. Temperature has also been a factor early this week, with parts of the eastern United States experiencing a late season cold snap. Overnight lows dipped into upper 20s and 30s in some regions, bringing frost and freeze concerns for early planted crops. That cooler air mass is now being replaced by a rapid warm up, with temperatures climbing into the 70s and even 80s in parts of the central and eastern U.S. This sharp swing in temperatures adds additional stress to crops that have already emerged and contributes to the instability needed for storm development later this week. At the same time, drought conditions have not fully eased across key agricultural regions. Large portions of the southern plains and parts of the southeast continue to deal with ongoing dryness. While some areas are receiving rainfall, others are missing out, creating a split pattern where excess moisture and drought are both influencing production at the same time. This contrast is an important part of the broader weather setup and continues to drive variability across regions. Looking ahead, this is not a single event pattern. Forecast models continue to show multiple disturbances moving through the central U.S., keeping the threat of storms and rainfall in place beyond just this week. That means limited windows for field work in wetter areas and continued uncertainty around moisture improvement in drier regions. Overall, the weather story this week is centered on repeated storm activity, saturated ground in key growing areas, lingering drought in others, and wide temperature swings that are contributing to both crop stress and an unstable atmosphere. Markets were mixed to start the session, with livestock under some pressure while energy and hogs found support. Lean hogs are trading near 103.05, up about $1.32 on the day. That strength continues to hold in the hog market, with buyers still stepping in on dips. Feeder cattle are trading near 359.03, down $2.32, giving back some recent strength as markets work through higher placements and pressure from outside markets. Live cattle are trading near 243.50, down $2.57, with some pullback showing up after a recent push higher. The tone here is softer today, with sellers gaining control through the session. Crude oil is trading near $90.49 per barrel, up about 82 cents, continuing to hold firm and adding underlying support to the broader commodity space. On the grain side, Chicago wheat last seen trading near $6.13, corn last seen near 462. So market recap. Lean hogs finished higher on the day, up $1.32. Feeder cattle closed lower by $2.32. Live cattle were also lower, down $2.57. Crude oil pushed higher, gaining 82 cents. Grains were mostly quiet, with wheat near 613 and corn near 462. That's where markets stand as we move through this morning. A lot still developing across weather, inputs, and livestock, and that's going to keep things moving day to day. If you want to stay on top of the markets that feed America, make sure you're subscribed and you don't miss the next update. I'll be back with you tomorrow with the latest. This is Boots and Bushels.